Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here's the starting lineup for your 3 in 10 podcast. Tariffs come back into focus on August 1st. Meta earnings, a massive beat and a massive bet on the future of artificial intelligence. And number 3, non-farm payrolls, a decidedly weaker report and enough to move the odds on Fed policy. So back to tariffs. President Trump is doing nothing less than attempting to reshape global trade and commerce. The average U.S. tariff rate will go from low single digits to around 15.2%, according to Bloomberg. That seems to us to be well less than what we feared on Liberation Day, but still more than we hoped. We were hoping for more around the 10 to 12% level, but the president's been pushing it in the last few weeks as stocks have been making new highs. OB3 got passed and he's feeling his oats and he's decided to push the number higher. The new tariffs will take effect on August 7th. The rates will vary, of course, from country to country. China, India, Mexico, Canada, Switzerland will face much higher rates, it appears, than 15%, but there will be many countries that are also down at the 10% level. Let's just remember that tariffs are a consumption tax. I would maintain an inefficient consumption tax because it's more difficult to collect than something like a value-added tax. We're essentially moving the tax collection from the IRS to the Customs Department, which I'm sure is probably not nearly as equipped to handle this mission. But as we know from what Milton Friedman taught us, if you tax something, you will get less of it. So we will get less consumption as a result of this, and growth will slow at the margin. Inflation, in my opinion, is still likely to rise. It's been a delayed pass-through. There was a lot of inventory hoarding, and I think companies have just been unwilling to pass through the price increases to consumers immediately, not really knowing where the tariff rates were eventually going to settle out. And by no means do we know where it's all settling out as of August 1st, but more and more as time goes by, we're getting a sense of where this is going to fall out. And it looks like 15% is about the number. So equities are overheated, a lot of complacency coming into the weakest seasonal of the year. We expect the S&P 500 to trade sideways to down in August and September, which we know is the weakest seasonal. I think the surprise here is a deeper correction, somewhere on the order of 5, 7, 10%. The consensus now, I think, is for flat to down over the next couple of months. And I think the surprise is that it could be a deeper correction. We get much more excited in the 5,900 to 6,000 area for the S&P 500 because it cools things off. That would represent a 7, 8% correction from the highs of last week. And we still believe underlying all this is a new bull market. And we want to buy that bull market, but we want to buy it right. Now on to number 2, Meta earnings. I think Mark Zuckerberg may be the best CEO in technology today. The guy is ambitious, he's audacious, he's gutsy, he's savvy, he's smart, and he's absolutely ruthless. He has the audacity to use a large portion of Meta's prodigious cash flow to go all in on artificial intelligence. And I think that's the right bet. Meta is a cash flow machine. And when you think about the world out there, private equity is going to have a very hard time matching the cash flow of Meta. The only 2 companies I can think of that really can, that are already positioned, are Microsoft and Google. And I think they will be far more timid in the way they go after this than Zuckerberg. He is pursuing a massive talent grab, and he's been successful. He's the one guy who's had the guts to really go for it in terms of talent. You can say he's overpaying, but when I give you these cash flow numbers, you will understand why he can way overpay for talent. So the second quarter earnings report was an absolute blowout. Second quarter revenues, $47.5 billion, up 22%. Think about that, 22% on a number that big. Net income was just over $18 billion, or $7.14 per share. The street estimate was $5.80. They crushed the street estimates. They beat the street estimates by over 20%. That is what you call a blowout. Free cash flow, always the most important number, $8.5 billion. Meta repurchased over $10 billion worth of stock, and they paid $1.3 billion in dividends. They even were able to increase R&D by 23%. And the cash on the balance sheet is massive at over $18 billion. No wonder Zuckerberg can pay people $100 million to work on AI. Another thing that came out of the call, 3.4 billion people around the world use Meta applications every day. This company touches the most important people on the planet. Impressions were up 11% year over year. Pricing power up almost 10% year over year due to improved performance, and that improved performance is being driven by AI. So he's actually using AI to augment earnings, cash flow, and pricing power. I was interested in what Zuckerberg said about superintelligence. He thinks we're rapidly moving towards superintelligence. That is surpassing human intelligence in every way. He maintained on the call that things are moving far more rapidly than people realize in AI, and we're coming closer and closer to this superintelligence goal. I just felt like after listening to the call, if you want to bet on artificial intelligence, who better than to bet with than the Zuck? Number 3, non-farm payrolls this morning, a decidedly weaker report. The payroll employment was softer than expected on the headline at plus 73,000 in July. It was really the 2-month revision that got our attention. They were sharply weaker at minus 258,000. And that puts the 3-month average change at 35,000. That's really pretty weak. The household survey, as opposed to the establishment survey, showed a loss of jobs in July. The U3, which is the headline unemployment rate, went from 4.1% and just barely rounded down to 4.2%. It could have easily been 4.3%. Labor force participation fell for a third straight month, which is not a good sign. And average hourly earnings came in higher than expected. They rose 0.3% month over month, pushing right up to almost 4% year over year. And they were revised higher in June. So the one bright spot that I could find was hours worked were up, and that will boost incomes. That's a clear positive. So I think the bottom line here is the Fed is significantly more likely to cut rates in September, and the markets moved violently today from pricing at 50% probability of a cut in September to an 82% probability of a cut, and is now pricing 2.5 cuts between now and year end. So the U.S. labor market is cooling, plus you get a major consumption tax. Economic growth is going to slow down. 10-year U.S. Treasuries have declined by 13 basis points. That's a big move in one day, and the dollar is weaker by 80 basis points. So there you have it. That's your 3 in 10 podcast for Friday, August 1st, 2025. And as we always say, do the work, endure the pain of gain, and have investment courage.